Good evening, ladies and gentlemen. We have a great and highly experienced and diverse panel with us today. And the topic which we are discussing is family offices and investments. In the last 2 decades in India, several wealthy families have hired professionally run teams in order to manage their money. And this has brought about an increasing level of sophistication, refinement, not just towards the approach to investing, but also in terms of overall risk management, governance, etc. And I think as investors, you almost view a family office as a fund of funds of sorts, because you look at diverse products across equity, across debt, look at overall portfolio construction, look at response to macroeconomic triggers, etc. The other benefit of having a family office is that you can have a well-defined investment mandate, which is in line with the family's expectations. So I think with that in mind, as a group, we want to structure our discussion today predominantly in 3 parts. In the first part, we'll talk about the differences between a family office and a traditional wealth management platform and how they would manage the same corpus with different approaches to investing. In the second part, we'll talk about what actually defines the investment mandate for a family office, what drives that decision, how does that change in response to macroeconomic conditions. And then in the third part, we would like to look ahead and look at future asset classes or emerging asset classes, such as venture capital, high-yield debt, retail debt, and see how family offices are looking at these, evaluating the higher risk associated with these. So with that, why don't I kick off with you, Nitai? And let's talk about how a family office's approach is different vis-a-vis traditional wealth management,
Sure.
and also the benefits of institutionalization.
So, I mean, one of the basic differences that family office has compared to a wealth management outfit is obviously the entire team, that's built in-house and which is kind of trying to work out an investment mandate and work with the owner of that money to build an entire process, an entire thought process of what is the objective of managing that money. And once you have that objective, then what are the ways in which you want to manage that money to reach that objective. Now that is a big difference from a typical wealth management kind of setup, because there, unfortunately, the way the industry has evolved in India and even outside is that most of the wealth management setups have been transaction focused rather than trying to understand what the client actually needs. So when it's about smaller, and when I say smaller, it's relatively smaller corpuses, that kind of an approach still works, right? Because you have a reasonably large but yet relatively small corpus. You want to invest it into some 5 or 6 products. Your wealth manager shows you those products and you go ahead and invest into it. But when you're talking about a large corpus, the kind of corpus that single family offices normally manage, it's tough to do that without a clearly laid out objective with you or clearly laid out process with you. And that's where a family office setup or a single family office setup kind of works. And, right from the investment policy document, which tells you what are the kind of do's and don'ts, to actually setting down processes for evaluation of different kind of investment opportunities. So whether it's a traditional asset class such as direct equity or bonds or a new asset class such as venture, debt or equity, you need to have a completely well-defined process to evaluate those kind of investment opportunities. So which is where a single family office or a family office setup, which is, or even a multi-family office setup probably works a little better than the traditional wealth management setups.
Deep, would you like to add to that or respond to that?
Yeah, I mean, I think Nitai made very valid points. I think the other dimension that needs to be considered when you're talking about a family office is that investments usually is a part of what they do, right? Specifically, if you're a single family office, I think it really starts from bookkeeping upwards. So you really manage your debits and credits and ledgers and vouchers and all of that, and extends well beyond just investments. Yeah. It can include real estate, it can include concierge services, it can include facilities management. So the spectrum can be really broad. And there are certain specifics out of this which a wealth manager will never be able to provide. Purely because you can't expect sort of the sell side to come in and tell you about how to run your books of accounts. That's a job that has to be done by your accountant in conjunction with your sort of tax consultant or your chartered accountant. So I think those are subtle differences. And then you sort of take in the overall element of what an in-house team brings to you. Now the in-house team, again, depending on how you're structured as a family and what your needs are, can be focused more on facilities versus investments versus real estate. So if I am, I'm a wealth owner who's predominantly, an owner or wealthy because of real estate, then the needs may be very different. So I think those subtleties eventually come in. But I agree with what Nitai said. I think, that's sort of a subtle spectrum.
Yeah, and I think one of the things that was talked about in the morning also, Richard talked about an investment compass, right? That I think is something which is very critical, and as Deep just said, depending upon the kind of family office that you are, your investment compass will completely vary, with respect to other family offices. And that is something which only an internal team which is sitting out daily with the promoter of the family office or the principal of the family office can understand. It's very tough for an outsider, so to say, who interacts with you probably once a month or twice a month to really understand what goes behind, the entire thought process. So today, for example, you may be a manufacturing company who has a number of businesses apart from your investments. And for you, it's very important to understand that any new venture or any new business that you invest into needs to have some sort of a strategic tie-in with the kind of businesses that you're already in, right? And for a team which is internal to that particular promoter, that's easy to appreciate, because he's not just looking at the investments, but he's also got exposure to other parts of the group or other companies or other businesses that the family is running. So he knows the context. So I think that is the biggest difference, I would say. The context of the entire piece is something that an internal team or a family office kind of an approach would probably be better poised to understand.
Is there also a difference because, being effectively a professionally run team, you are product agnostic, so to speak.
Sure.
And so to that extent, on the other side, from a wealth manager's perspective, there's a lot of sell-side pressure. So how do you contrast that too, and in that context, what are the benefits of a family office?
Yeah, I mean, absolutely, because in a wealth management setup or in any setup where your entire incentive is aligned to the revenues that you make out of that transaction, obviously, I mean, even if you are, you want to do the best by your client, and, one would assume that every service provider would want to do that. But having said that, there are different pressures that you have because of the organization you represent, the house that you come from. So your advice may be colored. I won't say completely biased, but may be colored. But if it's an internal team where the entire objective is to generate returns for the family office or manage the affairs of the family or ensure that the intergenerational wealth transfer happens in a particular fashion or the interests of the family are protected, if that is your objective, then definitely you will work towards that rather than, just trying to make the quick buck and then trying to turn away. Right, so obviously I think that's a big difference that we would all have encountered, when we deal with wealth managers.
And these are obviously some of the benefits in terms of having family offices. But if we look at just the cost side, how does the model differ?
See, managing a family office today, so it's not really a huge team that you manage. And again, referring to one of the discussions that happened in the morning when we were talking about, how you set up a family office. So one of the key things that was mentioned was that you don't really need a lot of investment experts within the team and, escalate your costs of running the family office because of that. Maybe you need a couple of people who know investments. But what you need to do is you need to have people who can understand the strategy with which you are investing. So you have a couple of key people, maybe a couple of guys, associates, analysts who can, do the basic due diligence. But mostly you tend to outsource the real expensive pieces of managing that single family office. So you don't try and do it everything at the level of the family office. So in terms of costs, I don't think that, if you compare it to somebody with an equal amount of money to invest, another HNI who's not really having a family office setup, I don't think that there will be too much of a difference except, probably you'll be able to negotiate a little better because of the team that you have, and because most of the single family offices have got people who come from that kind of a background, who come from the wealth management background. So they know the pricing dynamics and they know how things work internally, within these wealth management setups. So they're able to negotiate slightly better. To that extent, there is an advantage. And so that's it, I guess.
With Deep, just on Nita's point on hiring the right kind of talent for this, is talent acquisition something you see as a challenge?
Yeah, I think it's a really important point because see, at the end of the day, if you throw peanuts, you'll get monkeys, right? And I think what we need to understand is that every function in a family office requires a specialist. So you cannot really expect the in-house accountant, which a lot of wealth owners have, to double up as the investment advisor or sort of the due diligence guy that's talking to wealth managers. That's suboptimal. And I think if you look at it in that context, it again comes down to sort of you as the wealth owner, what your wealth structure is, how it's come, and what your needs are. If you've got a pot of wealth which you want to run a long short book on, it's going to cost you differently compared to, let's say, a pure long only guy or an allocator of or sort of manager of managers. If you want somebody with a venture background, that will come with its own cost, because each of the professionals that you hire has a specific price point in the industry. If you want best results for your family office, you should have sort of at least be in the top percentile in terms of compensation. So I think, and the other piece is that you need to take a longer term view of this whole thing, because it's an investment that you're making. You're not going to start a family office today, shut it down 2 years later. It's being done with the objective of passing sort of an institution on to the subsequent generation. So in a sense, it kind of pays for itself. Finding talent though is a challenge, because you're effectively competing as a family office or as an employer that's a family office. You're competing with all the others in the financial services space, right? So I think, but there are the trends changing. There are more people open to meeting up and learning about this space. It's also the generic trend in which the industry is moving. A lot of wealth owners are interested and sort of want to know more about how this can start. I suppose that's one of the reasons why we're here. So I suppose it's a change that will take time.
Yeah. Sasha, you offer a very specialized product, which is venture capital. Just taking off on Deep's point on talent acquisition, is that a challenge for you as well in your space?
Not really, because in venture, there are very few venture capital funds in India, even though you read about a lot of them coming up every second day nowadays, versus the amount of people wanting to get into venture. It's still considered very sexy. It's not sexy, but it's just considered sexy. And the amount of resumes we get is staggering, literally on a daily basis, through LinkedIn, through other profiles. So from a talent acquisition, actually, we don't have a problem.
Product versus, I guess, the family office approach. Nitai, coming back to you, increasingly we are seeing a trend of the advisory model becoming prevalent, whereby traditional wealth managers are trying to engage with family offices. How do you see that progressing? Is it efficient? Anything we can change about it?
Yeah, I mean, so far what we've seen is, and it's kind of a catch-up or an attempt to catch up. And, a lot of wealth management firms who really focused on a transactional approach have started, hearing so much about family offices and about, how people are managing or trying to manage things on their own. And they need to be a part of that picture, right? And in order to be able to do that, they're trying to offer an advisory model. Some of them are really doing it in the true sense of the term, but most of them are trying to, cloak the existing thing in a new garb. That's the extent to which they go. And the efficacy of that advisory model is not something which has really come up so far. While there are a lot of people who are offering it, but I think it'll still take some time for the advisory model to really catch up. And one of the reasons for that is, even from a client's point of view or an investor's point of view today, it's very tough to for an investor to really cut an advisory check, right? So even though he's paying probably much more as a hidden fee, distribution fee or whatever, but when you actually ask the investor to cut out a check for advisory fee, that's still not something that's palatable to a lot of people. So unless that kind of mindset changes, it'll be tough for even the wealth management firms to truly offer an advisory kind of model, although that's something that's happening a lot nowadays.
So I think with that, let's move towards the second part of the discussion, which is, Deep, let's start with you. So in your experience, how does a family office decide what its investment philosophy or mandate should be? What criteria do you look at? Is it liquidity, diversification, risk management, of course returns, across what asset classes?
Yeah, that's actually a subject in itself, but rather than generalize the answer for sort of all family offices, I'll try and sort of answer this in terms of our context.
Of course.
I think it really starts off with, at least for us, to cut out a lot of the noise that's out there. I think we referred to sort of the sell side push in a sense, and if you take that approach, you'll end up being more transactional and therefore by nature suboptimal. Because you'll have sort of replicated the same position with different advisors, and that more often than not ends up being suboptimal. I think therefore it starts really, sound a little bit of a sort of old school. It sounds, you need to go back to the drawing board with every family member that's involved, sit and understand what their objectives are, because the patriarch of the family's objectives versus the sort of, the current gen would be very different. And then you formulate a strategy based on that. Within that, I think, the way we approach the whole thing is to sort of create a broad framework. It starts off with taking in inputs from our advisors, kind of work with an investment council setup, so that we ensure that we are not sort of agreeing with each other all the time. Yeah. You take inputs from external sort of advisors, other specialists, create a broad framework, and then take it from there. Specific to risk, return, objectives, again, it boils down to the investment mandate that you've sort of discussed with the family. And that can be a completely different spectrum. I think sort of a couple of, rather than repeating the regular stuff, which is sort of risk adjusted and all of that, specifically for, I think, wealth owners in India, two changes that we see. One is that sort of legitimate or declared wealth is not just restricted to a single currency anymore. It's possible that you are sort of investing in INR, but you're spending in US dollars, specifically if you've got kids overseas. Now that brings in a totally different parameter altogether. Can I formulate an investment strategy to take care of something like that? I may have a business which is predominantly earning in US dollars, or any other foreign currency. Can I utilize some of that within my investment sort of framework? I think those are some nuances that come in, and that's sort of where you need the specialist in-house, right? Because this is an element that very few wealth managers will be privy to, because it's sort of, very internal to the family and the businesses that they run. And you won't get this internal view till you have a specialist who's sort of looking at it. I don't know if that sort of answers your question.
Yeah.
Sure, and just taking off on what you said, do a lot of families do goal-based investing, or is that the predominant philosophy?
Well, I think it's always good to have a goal, because look, I mean, let's look at it this way. Most wealth owners in India are successful entrepreneurs, right? If you want to run a successful business, you've got to have a goal. That's where it starts. It needs to start with a goal and a vision. And I think the mistake we make with investments is to not have that, because then you're sort of floundering here and there. So I think it's very important, and as sort of professionals here, it helps to have that discussion with the family members and be dispassionate about some of those things. So it really starts off with the goal, and then everything else sort of kind of align themselves. What that also does is that it cuts out the noise. Yeah. So if your goal is to make inflation plus 200 basis points, it cuts out a lot of things. I know that I need not look at A, B, C, D, E. And I specifically need to look at, let's say, high yield or something like that. I'm just using it as an example, right? So yeah, I mean, it's extremely important. I mean, even for the larger wealth owners, it really starts off from what you want to do with it.
Yeah,
And sorry, go ahead.
Just to add to that, I think, it is really two parts in which you look at this. The first part is where, as you said, you do the goal setting with the family members all together. And you try and figure out, what are the unique circumstances that the family is in. As Deep said, it could be people living in different parts of the globe, people having different sorts of expectations. So the second generation may not really want to do what the first generation has been doing. The first generation may think that, they know better, etc. So you really need to bring everybody together and draw out something called a family charter, right? The family charter then tells you what you need to do as far as your investment policy statement goes. So it's basically two documents, if I can call it that, which really form the backbone of family offices. The family charter is more of, subjective parameters, if I can call it that, where you look at, not just very clear mission statements, but also the emotions and the feelings behind them, because I think it's very important to look at that to be able to give a complete, a wholesome kind of a solution. And the investment policy statement is then the translation of that into actual do's and don'ts, right? And pretty much in terms of numbers and ranges. So that's more of a mathematical document, if I can call it that. And whereas the charter would be probably more of a philosophical document. And these two combined together will really tell you where you want to invest and what you want to do with the family's money.
And Deep, how often do you change the investment philosophy or mandate in response to external triggers? And how dynamic is the change in that allocation?
So I think it'll vary from investors depending on what kind of asset classes they're invested in, what kind of, I would say, products they're invested in. What definitely does happen is that there is always a formal review process, which could be monthly, quarterly, depending on the availability of the principals or interest of the principals. It's quite possible that in a family you will have 2 or 3 people who are very interested, who are on the ball and would want to chat with you every day. But then there are others who are, tell me what's happened at the end of the year. So I think from a professional standpoint, it's important that you stay engaged, sort of do the monthly, quarterly review process. And then sort of take a view based on the mathematical analysis that you do, which is if you've sort of met a return objective or if you think things are not looking good, and that's really where the specialists or the sort of professional specialists that you've hired come in. You can't expect the business owner to run his business and do this at the same time. It's just not possible. So I think it depends. Pertinent question would also depend on what kind of allocations that you have. So if your objective is to, again, like I said, just sort of beat inflation, you are unlikely to be in sort of volatile asset classes. So then it's more sort of, just to make sure that you're on track with respect to those numbers that you've set out at the beginning of the year. But yes, I mean, it needs to be dynamic because otherwise it kind of gets forgotten and, sort of gets into maintenance mode. That's not correct.
So Nitai, just taking this back to you, in your experience and in your family office, how do you go about deciding the investment philosophy? Anything over and above what has already been discussed which you'd like to share?
Sure. I think one of the things, and this is really referring to the changes in the investment philosophy, I think even the changes need to be defined, right? And what is the extent to which you can change? So when you set up your investment policy document, you also need to define what is the kind of tactical deviation that you can allow. So for example, equity is probably the prime example of an asset class where because of volatility, you may need to decide on any tactical deviations. So there you need to know that, there is a standard allocation that you've agreed for your family office, but this is the range in which you can vary from that standard allocation. Now, revisiting those ranges is something which we do at, once a year, where we decide that, okay, so let's say last year we said that we'll be plus minus 10% of what we agree, but things are looking really volatile. Should we change it to plus minus 15? Or things are pretty much, in range. Can we narrow it down to plus minus 5? So that's something we probably do once a year. But yeah, once we've decided that, then the tactical deviations during the year would, kind of fall within that range.
So I think with that, let's change the focus to looking ahead and seeing that there are newer and newer products which are coming into the market. Various emerging asset classes are there. And Sasha, let's take this up with you in the context of venture capital. In your experience, given you've now raised multiple funds, are you finding an increasing acceptance for a product like venture capital with family offices? And is there an increasing understanding and sophistication as well?
When we raised our first fund about, I think it was 5 years back, I couldn't even count 5 family offices on my right hand. There was that few. Many people had no concept of what a family office was, even though they were in effect running family offices. My own so-called family office was a meeting on Sunday evening with my dad, brother and me for 5 minutes, and we would mumble something and someone would just make an investment. It was that disorganized and haphazard. And then at the end of the year someone would say, hey, but you made a profit here or a loss. Yeah. It was completely messy, disaster. So there's certain families like mine which are not equipped to run a family office. And whatever little money I have, I'd rather give it to someone external, not have experts like these gentlemen come and join, because I have to then manage them and it's a different business by itself. And I'd rather give it to a water field or someone and say, okay, take it. Back to your specific question about our business, the dramatic shift. So we had some money from Indian family office in the first fund. So not even 2% of our fund was from India as far as family offices. But in the current fund, it's 30 or 40%, and we have all the way from some of India's largest family offices which are fully experienced to very small family offices which are managing sub 50, 100 crore, which is still a decent amount of money in my opinion. So it's really been a very, very interesting journey. There's a lot of sophistication. We've got very smart people like these two gentlemen on my right who totally understand our business in 1 minute and can ask all the right questions and then can go back and make a decision on investing in asset classes like venture capital or not. So yeah, it's been a dramatic change. It's great for funds like ours because you get local domestic capital from smart people, because not only do we get access to the families, but we also get access to the fund managers who are very, very smart like these two gentlemen on my right. So it's been a pretty interesting journey, a dramatic journey actually, and I think the game's not even started. But I strongly feel that more and more people will get going with their own family offices, because currently in India, most business owners, all their net worths are in their businesses. Yeah. But I was doing a study with someone outside, and I asked him the net worth of Bill Gates. So I'm sure everyone in this room knows Bill Gates' net worth. Can anyone guess what it is right now? It's all, say, 80 billion, 90 billion, right? How much of Bill's money is in Microsoft? Can anyone guess? 99%. So I'll tell you, sir, my data is 1 year old, so it's totally wrong now. That time he was worth about 70 odd billion. It was only 9 billion. Let me repeat, 9 billion. So you can imagine how much of his money is in Cascade, which is his family office, versus most Indian promoters at the level of Bill Gates. Let's take Mr. Ambani. He's worth 20 billion, 25, Jio now probably more, maybe less, God knows. But I'm sure 99% of his net worth is in Reliance. I'm 100% sure. So that's the reality of where we are. We are all 100% full into our businesses, versus the reality is the biggest and best entrepreneurs in the valley, in the US, are out. Michael Dell is 3 billion in Dell, 17 billion outside. And they realize that you can't have all eggs in one basket. So the Indian way of doing it is have 5 businesses, which I think is wrong, because you can't run 5 companies. No one can. That's why the conglomerates really long term can never really be valuable. It has to be one company, a Sun Pharma, full on, Mr. Whatever his name is, he's added. Yeah, that's right. Sorry, I can't be before. 20 billion net worth, one company, versus someone trying to do 20 companies. So long term, I see that happening, dramatic change, where people are going to say, okay, I'm going to take some chips off the block. And over a period of time, hopefully, it will become a Bill Gates situation. We're still a young economy, so I don't see that happening overnight. There's so much growth headwind in India that I don't see Mr. Ambani selling Reliance or selling his shares off so fast. But that's something that we're seeing increasingly happen and will continue to happen, and that's what funds like ours are well poised to take a small piece of that pie and take it forward.
And when you were raising the first round and visibly now, you find it much easier to explain the risks associated with the product, the whole education coming up the curve in terms of the product?
It's dramatically easier.
Yeah.
And there are people like them, so it's much easier. In fact, they know more than I do sometimes.
So let me throw that back to both of you guys. How do you evaluate riskier products like venture capital, high yield debt? Does that fit into the overall strategy?
Yeah, I think you need to have a very clearly defined process to do that, because there are so many funds which have come up over the last 3-4 years. So obviously when Sasha came up with this fund, there were hardly any funds. Like there were no family offices, there were hardly any VC funds at that time. But recently, almost every other day, you get to hear of a new fund carrying a new theme. So most of these are brilliant ideas, very qualified teams. And you need to learn to say no to a lot of these ideas as a family office. But you need to really have solid reasons for saying no. So for that, you need to set up a process, which we have tried to do, although, I can't say that it's a foolproof process, none of them are. But we've tried to set up a process where you have certain filters that you work with. And it's important to have those filters, because otherwise, you have only limited bandwidth and you can't really spend all of that in evaluating everything that comes to you. But once you set up those filters, then you set up where you ask a certain set of questions, you have your own questionnaire, you have your own model or your own framework to evaluate these kind of funds. So you run those funds through that framework. And what is important at the end of all this is that little subjectivity that you bring to it, because it can't all be about numbers and about data. It has to be that subjective feel about the team who is managing that fund, or an entrepreneur who is probably bringing a direct deal to you. So, that's more of a gut, and that is something that is discussed within the investment committee and is not just, left to the gut of one person alone. So there is an investment committee which talks to the fund manager or the entrepreneur, and apart from the data or in addition to the data, looks at all of that and then takes the decision. So I think the processes are kind of getting refined, and from a stage where there were no processes at all, we've come a long way. And I'm sure there is a lot that's still to be done. And as more and more family offices come about, and as more and more family offices start talking to each other, these processes will evolve further. We'll start learning from the best practices that we follow, and make it much better. I don't know, Deep, what do you...
Yeah, I'll just add one more thing. I think over the last 3 or 4 years, as we are talking, there's been an explosion in sort of these new product categories, right? You've got AIFs, you've got high yield credit, you've got a plethora of venture funds. I think, again, the way we look at it is time answers a lot of questions. So I remember 3 years ago or 2.5 years ago when AIFs first came out, there were a number of these emerging managers. And I think, at that time we took a view that you need to let this entire process, stabilize, not just in terms of what the product does, but also in terms of the regulator's familiarity. Otherwise they'll come and change tax regulations overnight and you're stuck with something that you don't know what to do with. Right. So, if you're sort of a, long-term guy or a long-term wealth creation-oriented family office, you have the flexibility of time, and that can be used to tremendous advantage. Specifically for funds like AIFs and credits, I want to see the fund perform through a boom and bust cycle. It all good, looks good on paper when you see 18% and 19% and 5 times cover and all of that. What happens if there's a bust? Right? So I think, with time, there'll be an inflection point, which will also make it difficult for people like us, because that means that along with the good managers, you'll also have to sort of sift through others who are sort of trying to just garner assets. That's when the process and the checklist and the math and all the subjectivity comes in. So I guess it's a combination of both. My sense is that in the next couple of years, we'll probably see an inflection point in all of this, because investors are getting smarter. They are starting to understand some of these categories. 5 years ago, I think people invested in venture or venture funds, not even knowing what a 7-year horizon would be like. And now they've gone through that cycle, right? So there's greater appreciation that I need to have at least a 10-year view when it comes to things like this.
Okay, I think I'm just getting a sign that we're running out of time. So thank you so much for your time, gentlemen, and let me just open the floor for any questions. Please introduce yourselves and ask the question. Okay, thank you so much.
Thank you.
Thank you, Chhavi. Thank you. Thank you so much. Thank you.
Thank you so much. Right, sir. Thank you. Yes, sir. Here's the building as a